Welcome to this episode of ACG's Growth TV. I'm Katie Maloney, and I'm joined today by Michael Vaccarella, Partner and National Practice Lead for Private Equity and Transaction Advisory Services at Wipfli. He joins me today to talk about M&A in manufacturing. Mike, thanks for coming on.
Happy to be here.
So activity in the manufacturing sector seems to have remained pretty steady, but we are seeing somewhat of a shift to smaller and more strategic deals. What tips would you offer acquirers as they're analyzing opportunities in this sector?
Sure. Yeah, the smaller end or the lower end of the middle market is pretty much where we excel. So that probably the two biggest things I would say, and we'll probably expand it to three, but the two biggest things are usually lack of consistency and language. And what I mean by those is the lack of consistency is typically on the accounting side. There's not a lot of sophistication. The groups don't have a large accounting, suite of employees. So it's just not what you'd expect. So it takes a little bit to get through diligence, to get through, they've got a normal day-to-day job to do. So they have to do that. So, but what we tell a lot of our groups that are buying in that end of the market, we're okay with bad, consistent accounting, but I don't need glimpses of greatness, because glimpses of greatness in accounting is a complete ebb and flow, and that inconsistency is it's super hard to get your arms around and talk through with the client, because they don't quite understand why it's inconsistent. So I tell everybody, just be consistently bad and we'll be fine during the diligence. So, but then what dovetails to that is language. We come in typically as a middle ground, almost mediator, because you've got private equity coming into, from a very finance, driven speak in a space to the lower middle market, which is kind of, they're very focused on their operation. They're very cash oriented. They're very tax, evasive in the way they act. So it's a little different mindset from a private equity perspective. So we usually have to, kind of smooth the language between both, and we have to kind of educate on both sides. So it's helpful to have someone who really focuses their time in the lower end with these companies, and they're great companies. They might have a little hair, concentration of customers, but those customers have been around with them for 20 years. So while it's a perceived negative, it's a big positive in that lower end of the space. So what I tell everybody is just have some patience. That's the overarch of the third point there. But just have patience in the deal, because if you rush it, they get standoffish at the target. If if they try to slow it down, the private equity firms usually get a little bit anxious and they're like, what are they hiding? So it's just patience and kind of just being around and almost developing more of a relationship with them and through the diligence than because more than likely they're staying on post closing. So you got to get that relationship up and running pretty quickly. And one little jab or punch that comes through, they remember. They're very they remember those things, and they bring it with them post close. So we like to just kind of make everybody a little bit more patient, happy, kind of develop the relationship a little better. I think that's important. It makes the transition to a portco go very well if you do that. So, but yeah, unsophisticated in most cases from a finance end. It makes it difficult. So.
Sure. And another thing we're watching, really in the wake of the COVID-19 supply chain meltdowns, there seems to be a renewed emphasis on reshoring.
Yeah.
How are you seeing that impact M&A within the middle market?
Yeah, I think we've seen a lot of our mid-tier manufacturers bring back some contract manufacturing in the United States, which is great. We like to see influx of new business and getting those things back onshore, but it's like, where is it onshoring? We see a lot of state movement within the U.S. and like, okay, are we going from a higher tax rate or a higher tax state to maybe a more business-friendly state or a tax-friendly state? So there's some movement even internally, almost like there's a inside reshoring that's also going on as well. So we see that kind of affecting. I mean, people move during COVID, businesses move during COVID. Now everybody's kind of getting their, getting a little more stable. I mean, And it's been good for companies to figure that out. They've had those in the plans. They may have accelerated. Well, COVID may have accelerated a lot of those things. It accelerated for me and my family. We moved from Chicago to Scottsdale. So it was one of those situations that, if COVID didn't happen, would these things have happened? And maybe in a couple of years, maybe not. But the supply chains just drove everybody nuts. You had logistics pricing going up, 10 times in some cases, and but an average of like 4 to 6 times, and now it's back to like 2.5 times as much as it used to be. So things move around depending on what you're shipping, obviously, and if it's air, water. But we've had some definitely discussions around creating a normalization of those expenses over the last 2 years to what it's actually at right now, and it's coming down, it's stabilizing, but it wreaked havoc on working capital discussions, and actually even in deal, full-on purchase price issues, and elongating the deals in the last 6 to 8 months, because it was like, where we came from in the prior year was like, get in, diligence, deal close, get in, diligence, deal close. It was so fast, and now we're seeing this elongation again of deals taking a little longer. People are doing a little bit more diligence. They're, a few of their deals that they rushed through, or at least were faster, they're starting to see some things shake out that they don't like. So everybody's gone back, gotten a little more disciplined, and the speed is slowed, which I think is good for everybody. I think that's, it creates a better diligence environment. You get to know the company better. There's not these, you don't show up on day one of the integration and find things that no one knew about.
Surprise,
right.
Yeah.
So we try to keep the skeletons, to a minimum. So yeah, absolutely.
Are there any other trends within the manufacturing sector that you have your eye on through the rest of 2023 or even beyond?
Yeah, I mean, everybody's, I think, at least excited for and we're excited and dissatisfied. I mean, the excitement for the tax arena kind of to stabilize for the Trump tax cuts won't expire now until 25. I don't see anything changing in 23 and 24, at least we don't think so. So that's helpful from a stable market it gives some runway to those lower middle market companies that have been fighting about, I can hold on, I can not sell yet. I think that's finally going to say, okay, I'm sitting here in the middle of 23 and saying, I got to get to market and done before 24 expires. So we got this track rate in front of us, 18 months or so, that I think will bring companies to that. Commercial real estate, a little scary I think for everybody. I mean, we're watching people reduce their footprints, as they're starting to renegotiate leases. So what's that going to do to the overall commercial real estate market? A lot of these small businesses own the buildings they're in. Are they going to want to then dispose of those on closing with, when they go to sell and become a portco? Are they going to want to be the rental, and do a long-term lease back to the private equity fund or to the portco? I don't know. It's going to be strange. I think there's a lot of people in different cities that I think are reducing footprints or thinking about it, and what that'll do to kind of the surrounding manufacturing, environments that are usually just outside the city or in the industrial parts of the cities. So we'll see. I think I'm bullish on the year of the add-on, as everybody's kind of talking about it, in end of 23 to 24. But it's those add-ons like we talked about earlier. You got to be patient with them. I mean, they really haven't wanted to sell. Every time we try to push them to sell, they push back, and they're getting older. Those business owners are getting older. We've had a few, random, sicknesses, deaths, that happen, and then now the trust takes over, and we're seeing that in our client base, and we don't know what that will bring. I mean, thankfully we all got past COVID, pretty well, so there wasn't, this mass, extinction. So everybody, in those first couple weeks, people were pretty freaked out.
Yeah.
So, I think, nobody knew what to do. Business sectors kind of, do. But I think the PPP funds all kind of did what they needed to do. We see a lot of the smaller businesses, took less than $1 million or $2 million, and now they're sitting flush with cash. So, it's good for the owners. They finally can see, they can take some of that money, they can do some reinvestment. So I think they're doing the right things to become the next round of add-ons, because they've got the cash and some growth capital. So they're doing little things to get ready. which is good. You know, we're talking to our clients a lot about, you know, sell side quality of earnings. Can you get your, you know, you're not going to sell the house without, you know, painting the trim and tightening the doorknobs. So got to do a few things for them and kind of get them up to speed. And again, it comes back to that language of, you know, now they have to shift their mindset and start to talk like their potential buyers are going to talk. So we like where it's going. I'm bullish on the end of from now until 24 that I think there'll be a lot of deal flow coming out of the lower middle market. You know, I'll call it 1 to 6 of EBITDA, 1 to 4 of EBITDA. They'll be a little hairy, but patience will run out, guaranteed.
All right. Well, Mike, thank you so much for joining me on Growth TV.
Happy to. Thank you very much.